start? Okay. Yeah. Thank you everyone for coming. Yeah, I'm Federico Tenga from Bitfinex. Hendrik, do you want to introduce yourself?
And I'm Hendrik Ghys from Thalex. We're a new options and futures exchange that's excited to be actually partnering with Bitfinex. We hopefully soon we will bring our options to all of the Bitfinex customers in the coming weeks. And this is why we're giving you a bit of a workshop on how you can start trading these options and futures very soon on Thalex.
Great. So yeah, the scope of this workshop is to provide a little bit of an overview of what option and futures trading is, and also a little bit of why it is important, not only for the people that want to trade, but also for the Bitcoin ecosystem in general. So I mean, we have only 1 hour, so yeah, no one is gonna become an option expert in 1 hour. But yeah, hopefully you can if you start from zero, if you know a little bit, you can get the basis that then you can use to learn more about option trading and start like over time trading options, starting from the most simple things that you can do. At least you become aware of what you can do, and then maybe become more sophisticated over time. So first and foremost, not anything that we will discuss today is not a financial advice. It's just like an educational effort to get people to know more about this kind of markets. So let's start with some basic definitions to get everyone up to speed. So let's start with from what is a future. A future is a derivatives contract that obligates one party to either buy or sell, depends on which side of the trade is, an asset. So in the cases we will discuss today, mostly Bitcoin, at a predetermined price at a predetermined future date. So an example could be like that I enter in a contract where I say I commit to buy 1 Bitcoin at $75,000 at the 1st of June of next year. So this contract will have a value, and the value of the contract will depends on two things: on what is the value of the underlying, which is what is the value of Bitcoin right now, and how far away is the expiration date. So let's say that right now the value of Bitcoin is around $68,000. So the right to buy at 75 is not that interesting, so it's not so valuable. But it's quite far away in the future. It's 1st of June of next year, so anything can happen from here to the 1st of June. So yeah, the fact that it's far away it still can give it a positive value. The fact that I commit to this, and so the value of this contract can change over time depending on the Bitcoin price, and is gonna be strongly correlated and over time converge to the Bitcoin price itself. While options are a little bit different, because an option is a contract that gives you the buyer the right, not the obligation, as opposed to the future, the right to buy or sell the underlying asset. So in our examples will be Bitcoin at a specific price or specific date, or depending on how the contract, the kind of option, it can also be earlier, but usually it's at a specific date. So an example is that I have the right to buy 1 Bitcoin at $80,000 at the 26th of April. So I don't have the obligation to do it. I may or may not do it. So it's not that I commit to buy, I just have the optionality to buy. So if the price of Bitcoin is gonna be, I don't know, 70,000, I'm not forced to buy. So I'm not gonna be forced to buy at 80,000 something that is worth less. If the price of Bitcoin is 100,000, then this is very good to have this optionality, because I can buy at 80,000 something that is worth 100,000. So you can see that there is some sort of asymmetry. So if the things goes well, I can make it can be very good. If the things go bad, I'm not forced to buy at a loss. So there is some asymmetry compared to the future, which makes it very interesting for different use cases. Option, future and option in particular, they became widespread and popular like quite, let's say, recently for most assets, but actually they are quite old. I mean, they've been around for a long time also, because if we see it like this as a contract, as an obligation or a right to do something in the future, we can imagine that, yeah, for as long as we had trade, people will do this kind of contract between traders and merchants for all kind of assets. But yeah, it's like with the globalization of commerce, then and with shipping, that this became more useful and more widespread. And yeah, maybe you, Hendrik, you know a bit more about the history of yeah, derivatives for commerce.
Yeah, it's really something that grew out of the technology of shipping, right? And these trade routes that were set up with remote places like India, because then you have on both sides the issue that there's a long lead time, right, for both the buyer and the seller to be able to acquire commodities. They're on a ship somewhere, and it's a mutually beneficial transaction to be able to forward buy and forward sell these contracts. But the nature of trading commodities is that generally you're not symmetrically sensitive to price movements, right? We're more asymmetrically sensitive. We are, in general, when we're a buyer of commodities, we really just don't want the price to go up. If the price goes down, we're not that worried. And so that's how options sort of grew very naturally out of the future trade, when people just started saying, well, if I pay you a little bit extra just to have the right not to have to buy the commodity, if ultimately I can acquire it in the spot markets more cheaply. And that's how yeah, options became more of an insurance product on its own, and ultimately became traded as independent instruments because there was so much demand for it in the early 20th century. But this is a theme here that we will try to connect through all the different parts of this workshop, is that you know, options and futures are not these two different types of things. It's the same type of trade. It's often the same type of trade idea, and they're sort of two sides of the same coin rather than being separate instruments.
Yeah. So let's start to have a little bit of understanding on what we can practically use these tools for, especially as people that are interested in future and option on top of Bitcoin. So there are three main use cases for these derivatives. The first one, and yeah, probably the most useful one, is hedging. So you can use options and futures to hedge against unwanted price exposure. And this is particularly useful for people that are in the Bitcoin industry, and they end up to have exposure to the Bitcoin price, even if it is not their core business. Maybe they have a business that makes money in the Bitcoin ecosystem, but they don't want that to be their success to be strongly connected to the fact that the Bitcoin goes up and down. And this is, for example, the case of a miner. So if I am a miner, if I'm to be profitable, I need to be good at my job. I need to have like good to be able to strike a deal for cheap access to energy, to be able to buy a cheap miner, to maintain them, to have yeah, good operations. So if I'm better than than my competitor, I will be profitable. But the problem is that by being a miner, I also acquire a lot of Bitcoin inventory. So maybe I'm very good at being a miner, but then the price of Bitcoin goes down, and suddenly I'm bankrupt because maybe I had to get a loan to buy the part of the equipment. And so it's a shame that I had to go bankrupt even if I was very good at my job. So using derivatives, a miner can reduce his exposure to Bitcoin. So he can, for example, short a future or buy a put option, so that is basically already locking in the selling price of Bitcoin that he will mine in the future. So in this way, you can very well do financial planning. Say, okay, I know that I have this cost structure to mine the Bitcoin from here until the next 12 months, and I know that yeah, given my cost structure and given this price of Bitcoin, I can be profitable. So if he hedges himself, he can know already today that whatever happens, he will make money. Maybe it's not a huge amount of money, but he will make his margin. And with this certainty, he can also go to a lender, to a bank, or to whoever is willing to finance his operation. Say, okay, this is my business plan, and whatever happens to the Bitcoin price, I'm gonna make money, and so it's gonna have easier access to credit compared to say, I am gonna buy some Bitcoin and hopefully the price will go up or the price won't crash. So he reduces a lot of risk from his operations, and of course he also is giving away the upside. So yeah, he's mining Bitcoin, then Bitcoin goes to 200k, and he's not gonna profit from that because he's already locked in a lower price to reduce exposure to volatility. So this is, as you can already see, I mean, these tools are very important to enable many industries that they can be profitable, that they can serve the market. But if they have too much exposure to a very volatile asset as Bitcoin, you may have good players that may not be able to survive in the long term. The second way you can use derivatives is for leverage. So if you want to express a view on the market with more for more Bitcoin than what you actually have. So let's say that I have a strong view that the market will go up. Instead of just buy one Bitcoin, I can use $60,000 of collateral to open a leverage position, either with a future or through options. And yeah, future and options, they give you a different risk-reward profile. And yeah, this can be reckless. I mean, depending how you do it. So I'm for sure not encouraging anyone to do it, but it's still important that this happen, because if you have like a strong belief that the price will go in one direction, you should be able to express it in the market, because this is part of the price discovery process of the market. Because yeah, without leverage, let's say that there is one guy that has a very strong conviction that the Bitcoin price will go up, and 10 guys that have like a not so strong conviction, they're just not very optimistic, but they don't have a strong conviction that the Bitcoin price will go up, so they sell a little bit. With only spot, the guy that is very optimistic can only buy so much, and you have 10 guys that are slightly less optimistic, that they will have a more weight than him, because they all only have access to spot trading, assuming they have pretty much the same amount of collateral available. But with the leverage, the guy that has a very strong conviction, his opinion can be worth more than 10 people that have a very weak conviction. So this helps to have a better price discovery, because each market participant can more precisely express what is their future view of the market, instead of trying to approximate it with just buying and selling Bitcoin. Or like if you have a negative view of the market but you didn't buy any Bitcoin, basically without the possibility to short, you wouldn't be able to express this view. So if we want the market to be efficient, to truly reflect the belief, the collective belief of all the players, derivatives is very important, and derivatives are there, and they're available to as many participants as possible, and they work well. And the third thing that you can do with derivatives is yielding. So you can extract a premium for either taking risk or for locking collateral. So let's say that I mean, yeah, there are many ways you can do that, but for example, like a basic strategy is that I can buy one Bitcoin, one like a spot Bitcoin, and I can short a Bitcoin future. So in this way, the Bitcoin future always trades a little bit of a premium, because again, like it's settling somewhere in the future, so there is this time value of the contract, and so I can extract a little bit of value. Maybe, I don't know, depending on how far away in the future it is, but let's say I can extract 5% of the value, and where this value comes from is basically what I'm doing is I'm a counterparty for people that want to go long. So it's almost like if I'm lending them money to have a leverage position. So what I earn is like an interest rate like reward. I'm being rewarded to allocate my capital to this trade, so other people can express their view of the market that is opposite to my trade. So I'm providing something to the market. I'm locking capital that I could use for other stuff, for other investment, or to enjoy life. And because I do this, I get a little bit of reward, and this can be a way to get something from your collateral. So something that may be relevant for many Bitcoin holders. Maybe you have, I hope that you have a lot of Bitcoins, and maybe I don't know, now we are gonna be in a bull market, the price goes up, and you want to reduce a little bit your exposure because I don't know, you want to you expect that there could be a correction, or for whatever reason you want to reduce your exposure. What you will normally do is just you sell your Bitcoin. But an alternative that you have, you can like keep your Bitcoin and open like a short position, or like or start selling options, and in this way you can get something more than just selling the Bitcoin, because you're also offering your Bitcoins are being offered to the market to open opposite positions to yours. So I get a little bit of yielding, so it can be an alternative to just sell your Bitcoin if you don't need to spend them right away. If you just want to reduce your exposure without spending the dollars right away, you can open up a short position with either future and option, and get something extra, and can be like a nice alternative to just sell Bitcoin on the market. Okay, so like we already explored a little bit some of the good things about option, but to generalize, with option you can facilitate the transfer of risk from risk adverse player to risk tolerant player. So where the risk adverse player is the miners, or whoever ends up having Bitcoin exposure that doesn't want to have. And the risk tolerant player is the traders that want to have leverage, so he's happy to take risk because he's happy to have volatility, because he has a strong view on the market, and he think it can be very profitable for him. He's improved the market liquidity and the market the price discovery, because as we said, we have like each participant can express a very precise view for the market that they have on the price movement, so we can have a collective, more precise price discovery. It enables sophisticated investors to specify their exposure to Bitcoin, because you may have some sophisticated investors that maybe they have a larger portfolio that also include other assets, and depending on what happens on their on their entire portfolio, they may want to reduce risk or to increase risk, and just buying and selling the spot wouldn't be maybe enough, because maybe they want to have like some asymmetric exposure to risk, so they're willing to buy a premium. So when you buy an option, you pay a premium to have only the upside but not the downside. The premium can be quite expensive, but you get this asymmetric exposure to risk. So sophisticated investor needs tools that let them to rearrange the risk of their portfolio in a very specific way, also depending on what the other assets in the portfolio are doing. And in general, it creates more degrees of freedom to express a trade. You can take more views on the market, and not just up and down, but maybe up in a certain price range, up in a certain time frame, so you can have like more freedom to express your trade. The disadvantage is that you may have too much freedom to express your trade. So when you have too much freedom can be a burden, and can be maybe like a bit complicated to fully understand how to express your view, because these tools, they can become complicated if you actually start using them in a sophisticated way. So yeah, for a lot of people, maybe just buy and sell seems easier, and then yeah, using option leverage and edge their position. So maybe too much freedom can be a bit scary. And yeah, many traders prefer to just have like simpler linear trades. So the problem with options is that yeah, there can be a lot of complexity behind behind them. So it makes some time to become comfortable trading them. And option or order books can be a bit illiquid, depending on the. Some options are more liquid than others, but maybe the option that you want to buy or sell may not be very liquid, so this can be often be an issue. And yeah, arbitrage with option, it's harder than arbitrage with spot, because you cannot just move one option from one exchange to another like you do with Bitcoin. So so that it's also more likely that there will be price disparity between different venues. And yeah, the last problem that we are trying to solve, that we are solving actually, is that yeah, there are few venues that offer a Bitcoin option, but yeah, likely like yeah, with Bitfinex and Talex, we are gonna address this problem, offering a very good way for to option trading on Bitcoin.
Thanks, Federico. And so now we're gonna get to the part where we try to think about how to trade these options. But really, what we're gonna try to do is to see how far we can get thinking about trading options by using the language we already know, right? The language of futures, which is fairly simple and straightforward, right? There is your entry price, there is a price target that you want to achieve, and usually there's also a price level where you would cut your loss, right? Where you would put your stop loss order. And the starting point is to realize that if we look at the payoff graph of a call option, which you currently see here, and you would look at the payoff graph of a future position with a stop loss at the strike, it's exactly the same graph. It's exactly the same trade view, the trade idea. It's just that the implementation is different, and it's different in one very important way, in how it deals with volatility. Because the problem with a stop loss order, right, and we've all experienced this, is first of all, one touch and you're out. You're out of a position. And the problem is very often that positions stop you out. Maybe they protect your risk from time to time, but equally many times they also cut your gain, right? A stop loss order should also be called a stop loss stop gain order. You're just completely out of the trade. And the problem is that when volatility increases, right, your chance of just getting stopped out increases proportionally. And this is usually when traders start complaining on Twitter that, oh, the market is too choppy, right? I can't make money. Well, if you really think through what it is you're doing, right, the big problem with structuring this payoff graph with a future and a stop is that you're actually selling volatility. You're short volatility. And this is how the derivatives exchanges in crypto, from BitMEX on towards the leading Delta 1 exchanges of today, how they make a lot of money, right? Because traders come there and they think that volatility is their friend. Well, volatility is neither good or bad, right? The problem is that if you're implicitly, and maybe without fully realizing it, if you're structuring trades where you're short volatility consistently, you're not gonna make money, right? Especially not in Bitcoin. So let's think about like how then this downside risk protection is different with an option. And so I would argue that the right mental model to think about an option in the vocabulary of a future is to realize that the strike of the option is a special kind of stop loss. It has two additional powers. So first of all, it's rechargeable. It can be once it gets hit, it gets replaced infinitely many times afterwards. And the second thing that it has is it's not just a stop loss, it's also a start gain, right? When the price moves favorably through your strike, a call option implicitly puts you in the position again. And so this start gain stop loss is something that can be exercised infinitely many times without limitation. The only limitation is time. The only limitation is that an option expires, and that's where your protection ceases to exist. But it's a fundamentally different way of structuring the same trade. Because now, if we think about the value of choosing this start gain stop loss order, this actually becomes more valuable when there is more volatility, right? Because the simple question of how useful this thing is how many times are we going to hit that strike? And that's a function of volatility and where volatility realizes in space and time. So all else equal, right, when the price of the underlying is close to our strike, that's where this start gain stop loss order is quite valuable. Even if we're further removed from the strike, but volatility is high enough, then still there's good probability we will make good use of it. So that's also where the option still has a decent amount of value. And think of volatility and time as basically the same dimension, right? So volatility needs time to express itself, and the more time you have left, the more probability again that we have this start gain stop loss order that we paid a premium for, but that it will be put to good use. And so fundamentally, the call option idea of expressing the same trade as we would with the future is the same trade, but we're long volatility. We actually benefit from volatility. Whereas in the other case, we are selling volatility implicitly. And this is, I think, a very intuitive framework that allows you to reason pretty well about how an option moves, but without having to speak a different language, without mathematizing the option trade or speaking Greek. We'll just actually focus on one Greek alone, and I would encourage everybody to just focus on understanding how that one Greek works, because if you understand that, you sort of like 80 to 90% get the dynamics of all these other Greeks as well. So what are Greeks? Greeks are basically sensitivities of an option price to different inputs that would impact its valuation. So that's the where the price is compared to the strike. That's volatility. That's time to expiry, etc. But the most important one is just delta. It's just the question of if the Bitcoin price, for instance, moves $1 up and down, what is the change in the price of the option? And so a future, right? If we think about what's the delta of a future, it's actually always 1, right? That exposure to the underlying is symmetrically up and down is always 1. But if then we think back to our payoff graph and we think of the option as this instrument that captures upside but limits downside, then it's very straightforward to see that we cannot have a delta of 1 for the option. Otherwise, it wouldn't do its job. It has to be asymmetrical, not symmetrical. And so that means that it needs to increase its price exposure with favorable moves, and it needs to limit it all the way down to 0 with unfavorable moves. And so with a call option, therefore, the delta is between 0 and 1. With a put option, right, where we're sort of short a future, naturally the delta is between -1 and 0. And so delta really, the best way to remember it is to think of it as the degree to which the option behaves like a future or nothing, right? We are either in the position or not, and the option sort of indicates that probabilistically. But so it sort of like behaves in the middle between a future and nothing. And delta quantifies that behavior. This is actually what delta, this is what the shape of delta looks like if we have on the x-axis where the price of the underlying S trades relative to the strike. And on the y-axis we see the value of delta, which this is a call option, so we're ranging between 0 and 1. And then you see all these different lines, colored lines, that show how delta changes, how the shape changes in function of volatility. But let's just start with like the blue lines. Like these are the low volatility regions, and that's where delta just looks like this S curve. And if you really just remember this image and study it, you'll have basically the same information as reading an option book. Like all of these other partial derivatives are in this picture. So let's start with a simple. Let's start simply from the extremes, right? If the price of the underlying, right, to the left hand of the chart, if it's very low, right? Let's say our strike was 70k Bitcoin, and unfortunately we're at 50. Right? This option, right, most likely kind of behaves like a zero position, right? Its sensitivity to the price of the underlying is quite low. Why? Because at 50, even if we have a big move to 55, we're way too far from the strike. I'm desensitized to the price of the underlying because, frankly, unfortunately, I don't think I will ever reach my strike. On the other extreme, right, where we're deeply in the money, like where the 100k and our strike was 70, we're very comfortable. And there the position behaves much the same like a future. If then the price of Bitcoin goes up from 100 to 101, the price of the option will just also go up by 1. Its delta converges there to 1. The middle part is interesting, right? In the middle part, sort of intuitively, we're sort of in between half being a future and half being out of a position. And there our delta is then correspondingly around 50%. And we see that that's also where a small movement in price has the biggest impact on the way the option price changes, right? So there you see that in our S-curve, we're relatively steep. This is something that you might have heard is called gamma, right? It's the derivative of delta. But basically it says just how fast delta changes in reaction to a price movement. And very logically, because the strike is where we have this protection level and we're either in or out of the trade at the end of maturity. That's where we're very sensitive to prices of the underlying. So now we have explained gamma. Then if we think about volatility, it also again is very intuitive. Let's look again at the extremes. We're out of the money. We're at 50k. The strike is at 70. And let's say we have 2 weeks to go. Well, then I need a lot of volatility, i.e. a lot of speed, to traverse through space and time, to be able to still reach my strike. If volatility is low, then basically I'm defined by where I am at that point in space, and probably if I'm out of the money, I will stay out of the money. But if volatility is high enough, like the delta of an out of the money option can still actually be relatively high. So if volatility actually goes up, you'll see that all options, right, they converge closer to that middle of 0.5. If volatility is low, right, you see the sharp S curve. If volatility is high, you'll see that deltas flatten out. And as I said, time is kind of just the other side of volatility. Usually, all of the impact of time is directionally the same as volatility. So if I'm out of the money and I don't have enough time to get back into the money, I'll also have a binary delta. And if I increase time to maturity, then I flatten deltas as well. So all of these different dynamics of how an option moves are sort of reflected in this picture. And really just think about it as this S-curve. Think about like this identity question, which is, am I at the end of the day going to be like a future or nothing? And then if we then take this this framework and start thinking about positions, as I reflected in the last chart, it's really, there's many inputs to an option price, but really the main things you need to think about above anything else is just what is my view on price and what is my view on volatility, because those are the main drivers of value changes for an option. And then the key question is basically, do I want to be long or short convexity, right? Do I want to be long or short volatility, and what is the price that I'm paying for that? But if we think about like mapping it then to positions, a couple of words of advice. Like first of all, selling volatility is very dangerous, especially also if you're not at the same time at least hedging directional risk, right? So just selling, for instance, call options or selling put options and taking both downside directional risk, downside delta risk, and volatility risk is pretty dangerous. So the positions that I put here in the table as suggestions are better starting points, right? So if I think that price is going to go up and volatility could go up, I should, instead of structuring my trade with just the future and a stop loss, I might elect to buy a call option. And then there's a call spread as well, which is essentially, when you think of a call option, you could think of a call spread, which is essentially where you buy a certain option at a certain strike and you sell another call option at a higher strike. And that's basically a way to say, okay, I'm going to specify my price exposure. I could be, for instance, making a bet on Bitcoin, buying call at 70K, that's a certain premium, and I could actually get some of that premium back if I'm willing to say, I'll sell the strike at, for instance, 80K. Now I limit my upside exposure, but also by selling that other call option, I also limit the total premium that I'm paying. For delta downside, but a bet on volatility, you can do the same with puts and put spreads. I would say for the positions where you're sort of betting on volatility to go down, unless you really have a strong edge on volatility, there is not that many positions that I would recommend you do. But a couple of the basics ones are actually a very good idea, and these are generally used by pension funds. And it's sort of where you're selling volatility, often in a way to get some yield. So one is a covered call. This is where you're long Bitcoin and you sell some upside, right? You could have that same trade idea of like, okay, I'm long and strong at 60, 67, 68. And maybe at 80K would be a price where I would be willing to maybe take some profit. So you could put a limit sell order in a spot exchange or in a future exchange. Now you wouldn't be paid for that now. What you could do equivalently is say I'm going to sell the 80K call option. Now I'm sort of more or less delta hedged, not completely delta hedged, but I'm long in Bitcoin already. So if the Bitcoin rallies and hits my strike above 80K, I'm basically flat on the combined position. So that's a relatively delta hedged way of selling some volatility. And whilst there are very many option trades that are a really bad idea for retail or for people who are not very actively trading, a covered call is sort of an exception. It's generally a simple trade that actually gives you a decent amount of edge over time. In the case where you're betting on downside in the price and also on volatility to go down, I would say it's generally a trickier position to manage. It's harder to carry a delta hedge on the way down than on the way up. But that's where I would look into callers. So one of the way you could like manage the volatility of a buy and hold position in Bitcoin is to take a covered call, right? You sell some upside, but you also buy some downside protection with that. You buy some puts, and then maybe you're not like necessarily like betting or making a lot of money if volatility goes down a lot. But that would be a scenario where I would say you sort of sell and buy an option, and you benefit from the fact that you are actually you're actually managing your downside delta risk in a good way by hedging it with a volatility trade.
Maybe let's expand a bit about the cover call option as a way also to hedge risk and get some yielding, as it can be like the first option trade that you can suggest to people to do, especially for Bitcoin holder that maybe want to reduce their exposure to the Bitcoin price a bit. So what you do is, let's say you have 1 Bitcoin and you want to reduce your exposure to the let's say that there is a price at which you will be happy to sell your Bitcoin. So say at 100K, I will be happy to sell my Bitcoin. 100K is a good price. So instead of sitting on your Bitcoin and waiting now to get to 100K, you sell a call option at a strike price 100K, let's say, so at the end of the year or whatever expiration you pick. So what you're saying is like you're selling to someone else the right to buy from you Bitcoin at 100K. So when Bitcoin will go over 100K, the counterparty will come to you and say, okay, I have the right to get from you. You need to sell me your Bitcoin for 100K. So this right will have a premium. So let's say the moment I sell this right to my counterparty, I will collect some premium. I don't know, maybe like 5K, depending on the strike and the expiration, how far is the expiration. But let's say I get 5K immediately. So this means that whatever happens to the Bitcoin price, I have my 5K. If the Bitcoin price goes over 100K, from 101 to 1 million, I will get 100K for my Bitcoin. If the Bitcoin price never get to 100K, what happens is the counterparty will never come to me to say, I want to buy your Bitcoin for 100K, because they can go to the market and buy for 90, 80, 60, 50, whatever is the price. But I still have the 5K of the option that I sold. So I still get something either way. So in a way, I mean, I'm still have some sort of, I didn't completely eliminate my exposure to the Bitcoin price, because if the price goes down, I will still hold my Bitcoin. I'm not, no one is gonna buy my Bitcoin. And so like my value in dollar of my portfolio will still go down. But at least I have the 5K premium that I sold the option. So I'm still in a better situation, like if I did nothing. And yeah, if the price goes up, I may miss on some upside, because if the price goes to 200K, basically what I get is 100 plus 5 of premium, so 105. So I may miss some upside, but basically I upfront decided that 100K was a price that was good for me. So it's like, okay, I will take 100K plus the premium. So it is a way for people that say, okay, maybe like I want to sell Bitcoin at the end of the year, because next year if I sell at this price, I will be happy, because it's a price good for me, because I don't know, with 1K I can buy a new car or whatever. So this can be a good trade, because you get the premium extra on the cost of the option. But yeah, you may still have downsides. So like for people that maybe really need that money, it's not ideal. But if it's something like, yeah, if he gets to 100K, I'm gonna buy a new car. But if he doesn't, I can wait longer to sell my Bitcoin, or I don't mind to have exposure to keep exposure to Bitcoin a bit longer if that's the case. Then it can be a very good way to get some yielding from your Bitcoin. And the best case scenario for you is actually that nothing happens, the price of the Bitcoin doesn't move that much. In this case, you got $5,000 of premium for neither missing out nor keeping exposure to something that goes down. So in a situation of low volatility, the fact that I sold a call option is very good. So especially if you believe that not much will happen on the market, selling call option can be very good. Let's say, we can look at some example also to make it more practical.
Exactly, because let's see if we can figure out some election trades. So what I just put on is the 8 November maturity, which is 2 days after, I think, the presidential election. So that's sort of the election strike. So let's look at like different ways we could structure a trade. First of all, do people feel like it's going to be a bullish event or bearish? Bullish? Okay. So what's the price level we could hit? 80K? Okay. So 80K is a price target, but where would it make sense to buy in? So think about like then the strike that we're going to choose is, well, first of all, what we just already see is that of course the further out of the money, the cheaper the premium. So what do we think in terms of like price impulse, right? Like basically, right, if you buy the 70K, of course there's a higher payoff when we do get to 80, but you pay up more premium. And also, of course, you need to think about like, if I reach 70K, right, that's not necessarily breaking all-time high. So there's also maybe like a chance of price like hitting resistance there and sticking around, and then I paid this premium, but maybe it will not return itself. So maybe one idea is to say let's take if we're really bullish, we could take a slightly further out strike like 72K, 74K, pay less premium, but also we have a bit more convexity. We have a bit of a higher potential payoff if we reach 80. So let's maybe look at that, right? So if we buy 72k strike, we hit the bid at around 1700. So we paid 1700. If we reach 80k, right, ultimately the payoff is very simple. We made 8k on 1.7, so that's roughly a 5x return, which isn't too bad. Now, the problem, of course, within that 1.7k premium is that we are implicitly paying for the potential, of course, for Bitcoin to go in the next 2 weeks to 100k, 200k. And so maybe it makes sense for us to say, well, I see a lot of upside, but maybe not unlimited upside. So why would I not try to discount my premium a little bit? So maybe there the idea is that we actually sell the 80k strike, and then we get, let's say, around 400. We get around 400 in premium back. Now our net cost is around 1300, and so if we get our 8k maximum price target, now we're up. What is it? 6 to 7 times. So ultimately, now we've created this trade that actually has a decent payoff, but also it's long volatility, not shorted, right? If I would like try to do this with futures, that's not a bad idea. But you know, if volatility picks up in the next 2 weeks towards the election, there's a high chance that I get stopped out, and that I need to re-enter the trade dynamically again. So that's a lot of work. What's maybe another way to structure the same trade if we're saying, well, for instance, let's say you're already long Bitcoin and you think you're gonna stay long because maybe it hits 80k. What's another way we could actually now structure our downside risk better than to use a stop loss? You already probably know where I'm going with this. But well, we could look also at the at of course the puts. So another way to look at it is when you build up towards an event, right? You could have an event that doesn't necessarily materialize in terms of the expectation, and then there could also be like a sharp downside move. And maybe we're just happy to be long and strong Bitcoin over time, and we have no concern that that's gonna lose value over the long run. But we could also be opportunistic and bullish in the short term, yet still say, well, if we don't hit like an all-time high on the election, then probably we could actually have a big setback. And then what we could also do, instead of having this stop loss order, we could try to buy a put option where our stop would be. And in that case, what happens is, let's say we put it at 64, right? Then we pay 1200 in premium. But now if then Bitcoin really crashes, right, I start having, of course, the convexity on the downside. And what's also very important to understand is it's not that I'm actively betting on Bitcoin going down. I already have Bitcoin. I'm just at that point saying I don't want to carry all the downside risk below 6400. Effectively, if I buy the 64k put strike, I sort of break even from a level of 62.7, 62.8. Any price movement below that, right? I start to flatten my exposure. And now the great advantage is, of course, that this gives me the liquidity in cash to buy more Bitcoin if it dips below 60. So you could also use puts in a way to sort of position aggressively around like your core idea, which is just be long, right? You can be bullish in spot, or you can be bullish with options. And here the idea is just that if volatility, right, picks up to the downside, I'm gonna now create insurance for that, and that allows me to buy myself back into Bitcoin at a more attractive price. And if then ultimately price recovers in the long term and gets back to 70k, I'm just there with not 1 Bitcoin, but maybe 1.3, 1.4 Bitcoin. So again, it's really thinking about direction, but also thinking about volatility, and being long volatility instead of being shorted.
Yeah, let's also like explore another scenario. So let's say that I mean, like 4 years ago, it's gonna take us some time to figure out who actually won the election. So we have a few weeks they need to recount the votes and like whatever. And so at the 8th of November, we actually have no idea who won. So what happens is that probably, I don't know, my opinion is that probably in that case, not much will happen to the Bitcoin price because everyone is still waiting to figure out who won the election, and so they don't know if we will go up or down. So in this case, if we believe that this will be the case, which is actually a somewhat likely scenario, it means that maybe the market thinks that there will be more volatility on the 8th of November than there will actually be. Because if a lot of people are like buying calls and buying puts because they think that either one candidate will win or the other one, then they're saying, okay, they all expect that there will be a lot of volatility on the 8th of November. But if actually there is no volatility because on the 8th of November we still have no idea who won, then there won't be much volatility. So if we believe that, what we should do is to sell option, sell calls, or sell puts, so to collect a lot of premium and then the price won't to move much. So like I want like my option won't be won't meet the strike price, so I won't lose anything, and I collected a lot of premium. So as you can see, like there are we can imagine many different scenarios on how this event can affect the price, and for each scenario you can very precisely express a view on the market that will give you a profit if that scenario actually happens. So either like someone wins, someone loses, nothing happens, like we get like the guy I don't know, like the pro Bitcoin candidate who wins, but actually the price doesn't move too much, so there is a correction. So whatever is your view through option, you can express this view and have a good gain if you're actually right.
Can you buy volatility undirected?
Sorry?
Can you buy just volatility without direction?
Yeah, so
Yeah.
that's called a straddle. So that would be, for instance, at 70k here, buying the call and buying the put. But that's an expensive trade, right? So okay, great. Like whether Bitcoin goes up or down, you make money, and if volatility increases, you make money. But the premium is also correspondingly high. So if I look here at the screen, that's around 6k in premium. So that's 10% of your, you know, or not fully 10%, but let's say close to 10% of like one Bitcoin for 2 weeks.
Can you have range for buying volatility? Like volatility will be higher than this level, but not higher than this level. And then by doing that, you reduce the premium you pay.
So yeah, you buy the call, you buy the put, and then you sell the call and sell the put more far away from the strike. What you can do. So for example, yeah, you buy the call and the put at 70, then you sell a put at 60 and buy a call at and sell a call at 80. So you collect a little bit of premium that partially compensate the price that you pay for the call and the put you bought at 70. So it's gonna be slightly less, a bit less expensive, but giving away some of the upside if something very extreme happens.
But so looking at this table, which is still 2 weeks to go, so that's a relatively short time to maturity. Like this butterfly idea that Federico just explained, like on your 6k for the straddle, you reduce the cost now to like 5k, but you also then don't have that those extreme events. You don't benefit from them anymore, so it's fairly expensive. But these ideas can be better when you look at longer time frames. Yeah. And then one thing also on the covered call idea, right? Let's say we do want to do a covered call. We're long Bitcoin. We sell a call at 76. Now you could argue then the risk is I'm flat in my exposure above that. But it's also important, of course, to realize that nothing prevents you from then saying, okay, I collected the premium. I'll buy myself back in, let's say at 77. And that's then a way to hedge the upside risk of the covered call. And so there's ways in which you can really go sort of in between, back and forth, by combining futures and options in a way that you have, as Federico mentioned, where you can really specify like these specify like your exposure in different parts of space and time in a way that you could never do with just futures alone.
Can you tell us what's the difference between your product and Ghys?
Between Greeks.live, you mean?
Yeah, Ghys, yeah.
I think
Greeks.live.
Greeks is just is ultimately just a broker, and we're the exchange.
So you provide API access to Deribit, yeah?
No, so we are our own exchange. We're competing with Deribit.
On exchange, okay.
Well, first of all, the specs are different. So we have linear contracts that are stablecoin settled. Then there is a lot of sort of details in which we optimized the tech. We're a much newer system. So for market makers, for instance, we offer much lower latency. And then the other approach and where we're different is really just not just the product, but how we distribute it. So we have a distribution strategy of partnering with other exchanges, and Bitfinex will be the first of that strategy.
Where are you co-located?
So there's no co-location right now. Everything is in the cloud, which is in AWS Ireland.
Okay, I think we ran out of time. So maybe if there is one last question, we can still pick it. But okay.
This is live, right?
Yeah.
So, why is there such low volume? Like the open interest is like
Because we're
28
relatively new.
Bitcoins.
Yeah, it's just we need to recruit customers. We're just kicked off like a new incentive program a few days ago that will incentivize takers. Our liquidity now is already good. So our first focus in the last 6 to 12 months was really getting market makers online. Right now our spreads are comparable to Deribit, but yeah, to your point, we now need to start boosting volume.
Okay, so you just launched it. Is that it?
Yeah.
All right.
Okay.
So just one question. As I understand, Bitfinex, it's like underwater for this option exchange. Yeah, you don't work with Deribit. You work with Bitfinex, and Bitfinex is like a liquidity provider. Yeah.
So
No.
yeah, what we're doing in the partnership between Bitfinex and Talex is that we make it easier for Bitfinex customer to trade the derivatives that are on Talex.
So it's like a competitor to Deribit.
Yeah.
Yeah. So yeah,
Okay.
we give our
And,
customer option.
Just one question regarding market makers, because on Deribit they officially they don't have a market makers. And do you have market makers? I mean, in part of liquidity in order book or spread in order book.
Yeah. So we have a liquidity program that's 250K a month in USDT, and basically what we create is a scoring system where we pay out that fixed reward based on different market makers' share of that liquidity contribution. And now we added just a week ago also 250K in volume incentives. So yeah, it's expensive. But what we do is we try to play fair and have a level playing field. So a lot of other exchanges, they started with internal market makers, which we will never do. But yeah, it's you need to incentivize market makers to start providing liquidity before there are the customers, and so these incentive programs are solving that. But as you can see now, like the spreads are already comparable to Deribit, and there's also decent depth. So I would say the liquidity program is relatively soft. We have around, at least for options, we have around 8 market makers active today. Of course, more are always useful. But really, what we need to get now is takers, is people who cross the spread.
Can I ask you one more question?
Yeah.
Do you have plans to launch options on second-tier tokens like Ton, I don't know, Ripple, Solana?
Yeah, as soon as we validate like the distribution strategy with Bitfinex and then get volume in BTC and ETH, we will do altcoins. Yeah.
Okay. So yeah, thank you so much.